Everyone talks about rental yield, cash flow, and tenant demand. But today we're diving into the real wealth builder in property, equity. Equity is what separates someone who owns one investment property from someone who owns 5. Now, most investors don't fully understand how powerful equity can actually be or how to unlock it strategically. In this video, we'll break it down for you, what equity is, why it matters, and how to access it, and most importantly, what you can actually do with it to accelerate your wealth creation. Let's start with the simple definition. Equity is the difference between what your property is worth and how much you owe on it. So if you have a property worth about $600,000 and your loan on that property is still $400,000, your equity position is $200,000. That's how much of the property that you technically own. But here's the catch. Not all of that equity is usable. Most banks won't let you borrow 100% of the property's value. Instead, they cap you at around 80% of the value. So in the $600,000 example, 80% of the property's value is $480,000. That's your current loan. With your current loan of $400,000, that means you have $80,000 of usable equity. Now, why does equity matter so much? Because this is how you scale. You can tap into equity to fund your next deposit. You don't need to save another $80,000 from scratch. Your property has already done the work for you through growth, or the loan has been paid down. Equity is also what lets you leverage. Let's say your property grows $100,000 in 2 years. That's not money sitting in a savings account. That's capital that you can use to buy another asset. And here's the kick. The more properties that you own, the more growth you can benefit from. Compounding on multiple assets all at once. That's how you go from owning one property to building a portfolio that generates serious long-term wealth. So how do you actually unlock equity? Well, the first way to do it is to refinance. You replace your existing loans with a larger one, ideally at better interest rates, and draw down the usable equity from that. Banks will typically assess your equity position and your serviceability. They'll look at things such as your current income, your living expenses, and other debts. The property's new valuation will also be considered whilst they're doing this. So tip, if you're refinancing, you can also influence their valuation to an extent. Not all banks value the property the same. Sometimes you get better valuations, so look at multiple banks to see which can provide you the best result, because often this can result to difference of tens of thousands of dollars in value. Other things you can do is make sure the property is clean, tidy, keep a list of recent upgrades, and also consider comparable sales. Every $10,000 in higher valuation could mean $8,000 more usable equity for you. Once you've unlocked the equity, here's some options. Firstly, you could use that equity to go buy your next property. The most common strategy. Use the equity as a deposit and keep the cash savings untouched. Secondly, you could actually renovate your current property to increase its value, rent, or appeal to better tenants. This can create even more equity in the process as well. And thirdly, you can debt recycle by using this equity to invest in other assets that can help you keep your loan tax deductible but get great returns. Fourthly, you can use it to cover major costs. Maybe you need to fund the school fees or start a business. Equity gives you financial flexibility. Importantly, always make sure you're investing your equity into appreciating or income-producing asset. Don't use it for holidays or lifestyle inflation. So now let's talk about risk. Over-leveraging. So when you pull too much equity out, you might leave yourself in a vulnerable position where if the property value drops or interest rates increase, you're in a little bit of a cash flow strain. Just because you can access equity doesn't mean your income can support the extra repayments. That's why serviceability is key. Other things to consider is valuation surprises. So your equity might look good on paper, but a conservative valuer could reduce how much you can actually use. To manage these risks, always stress test how much you can actually afford to hold that property. With 7 to 8% interest rates, have buffers in your offset account, and focus on properties with strong fundamentals that you'll be able to hold for value. Equity is your silent growth partner. It works in the background as your property grows in value or your loan reduces, but it also becomes useful if you know how to unlock it and use it wisely. If you want help calculating how much usable equity you have, or if you're ready to explore what you can actually do with it, book a free call with us and our team at Handle Properties. We'll help you map out your next move. And don't forget to like, subscribe, and leave a comment below. How are you planning to use your equity in 2025? Let's get in touch.